Welcome to TMS Insights. Jeremy Hook and Ben Clark updating you on a different presentation today, one that is a direct interview with one of our highly esteemed colleagues in the industry, Stephen Atkinson of Adam Smith Asset Management. Many of our existing clients will know Adam Smith Asset Management because of the small cap fund that we've jointly had for almost 6 years now, and it's been a very high performing fund. So it was great to get Steve in today to talk about it. Ben, they're really good managers and they've been very good to our clients.
Yeah, and I think the reason we want to do this is we regularly meet up with Steve and hear about what's going on in the portfolio, but we always come away with it very impressed about the approach that Adam Smith took, and we thought that this might be the best way for clients directly to see how these guys do manage money. And to give a bit of background, we set this up in 2009, mainly because at the time we saw incredible opportunities in the small area of the market. However, we're also very aware that if you went and bought 3 or 4 or 5 of these, there's a good chance that 1 or 2 of them might go wrong and it might not be such a great decision. Through Adam Smith, you get a portfolio of 20 to 25 small cap stocks at a very cost-effective basis, in that there's virtually no transactional charges in buying or selling. So you can set this apart from your regular portfolios that we manage and still have access to that small cap market without taking on the risk of just having a smaller selection, which really only makes sense in an individual sort of account mode. The performance, as Jeremy alluded to there, has been pretty unbelievable. Adam Smith have outperformed the small cap benchmark by nearly 13% every year for the last 6 years, which is quite extraordinary. And we're going to give you some insight with Steve as to how they've managed to achieve that. And the third point I'd sort of make on Adam Smith is this is actually the only way that a retail client can get exposure to Adam Smith. They really only manage money on behalf of the very high net worth family money and institutional money. And so this is a pretty unique offering, hopefully, that we've put together, and clients really have, I think, benefited from it.
Yeah, they definitely had. We're very proud of the relationship, and we hope you'll enjoy the interview with Stephen Atkinson. Welcome to this edition of TMS Insights. Today I'm with the MD and Portfolio Manager of Adam Smith Asset Management, Stephen Atkinson. Welcome, Steve. Great to have you here today to explain about the Adam Smith Small Caps Fund. I guess best place to start, Adam Smith Asset Management, named after the great Scottish economist, Adam Smith, but a small cap manager, many years in existence and a great track record.
Yes, thank you. It's nice to be here. Thanks for having me, Jeremy. The idea behind the name actually is worth talking to, and the idea behind the name is the fact that it's the efficient allocation of capital, which is one of his theories about if everyone acts in their own interests, then society is best served. Our view is when you're investing in the small cap end of the market, you are giving capital to a company expecting a return, and we want that capital to be invested wisely and to generate a return for us as shareholders. The company has been around, as was founded in 2003, so it's around 12 years old now. We're Sydney based, and we call ourselves a boutique because we're wholly owned by the staff who invest in their products.
Okay, and you've been in the business of portfolio management for 18 years, and
yes,
it seems well experienced.
I hope so. So I've crossed quite a few different areas. I've invested across the Australian equity space, the REIT space, small caps, and even emerging markets.
Okay, yeah. And tell us about the thesis of small caps. I mean, obviously, a lot of investors can go their own way and pick 1 or 2, but having a portfolio approach and really knowing what you're doing, can you explain some of the pros and the cons there?
Yes, the idea we see in small companies is we can see quite a lot of volatility, and you can see competitiveness come through in their business models. So we see in the market, if you can minimise the downside to a stock, the upside will often take care of itself. So what we try and focus on is protecting our investment by looking for quality business models. A quality business model to us is one where there are barriers to entry, which affords a company some pricing power and protects their margins. We look for sustainable financial structures, which is an appropriate balance sheet for the type of revenues the company has and the amount of debt it can service. when we look for quality management. So going back to that allocation of capital, we want management who think and act like owners of businesses, as opposed to the alternative. And we look, just as importantly, for positive cash flow so that a company can pay dividends. We think that is actually important because history shows dividends are a large part of your total return in investing in equities. And positive cash flow also enables a business to fund its own growth without having recourse to shareholders necessarily. And over all of those, we place a valuation framework to make sure we're not overpaying for those attributes.
Okay, so it's got some broad metrics of how you go about it. If we talk about the portfolio, the Adam Smith Small Caps Fund that runs through the Evolve, the characteristics of that are that it demonstrates generally better value by price to earnings, EBIT multiples, asset multiples, and better yield as well than the market itself.
That's what we would always, and has been true today, that's what we would always expect to see. We want a portfolio that's cheaper than the market, but we also want a portfolio that exhibits, as you said, high quality. And in a simplistic term, in terms of portfolio metrics, high quality gets exhibited in high returns on equity for the companies. We also want a portfolio that's less highly geared. Mm-hmm. Once again, that means it has less recourse to shareholders, and we think good, clean balance sheets provide good management with optionality, and optionality is typically undervalued by the market. Mm-hmm. So it's something we look for. And the portfolio has historically had a high level of franking, which we think is very important for unit holders as well.
Mm. And let's talk about something pretty important. I guess volatility, how it performs in up and down markets. You've modelled this over a long period of time, 12 years, and the portfolio tends to do, particularly, very importantly for investors, better when times are a bit rough.
Yes, we think the hallmarks of a quality portfolio is a greater protection to the downside, and how we see that exhibited is in quantitative terms, the portfolio has exhibited a beta of about 0.7, i.e. it moves up about 0.7 the move of the market, but it moves down a lot less. The way we actually like to analyse that is how the portfolio performs in up markets and down markets. And over the history of the Adam Smith small cap company strategy, that's meant that in up markets, the portfolio has outperformed 46% of the time, and in down markets, it's outperformed 85% of the time. Mm. So we see the portfolio as protecting the downside, and the key reasons for that is that we're not speculating, we're investing in companies with those characteristics, which was positive cash flow, quality management, quality business models, and sustainable balance sheets.
Okay. The one thing everybody's waiting to hear, Steve, is performance. And performance can always move up and down, but over the length of time that we've had the Evolve portfolio, almost 6 years, there's been some tremendous outperformance.
It's been a very good period for small companies. It's interesting, going back to your original question, Jeremy, that for us, the small companies process isn't about the market itself. It's about picking the eyes out of the market. Yeah. And so the Small Ordinaries Index, which is the index we get measured against typically, hasn't actually had a great period of run for quite some period of time, and many people would be aware of resources and mining services used to be a big portion of the market, and that's not the case anymore. So being able to avoid overvalued sectors or sectors which have some flaws in them means that we can actually protect that downside, but it means that the performance gets skewed to the upside. So it's been quite a fruitful period.
Definitely, yeah. Great performance from the fund, and well done to you and the team on that, because it's certainly been great for those who've been invested there. I guess to talk about the portfolio, you're quite agnostic about sectors and individual stocks, and if we look at the portfolio today, you've got all manner of different kinds of companies in there, and people can certainly see how diverse the portfolio is and the kinds of companies. But maybe to focus on one for the benefit of the viewers here today, Avio Group, or one that you've had in the portfolio for a while, and it's a really good quality stock.
Yeah, so Avio Group is one of those opportunities that's come about because it has been a very poorly managed or undermanaged business and an overgeared business. Our entry to the stock, which was at about half of its asset backing at the time, was as a result of the fact that we saw a change in management. So we had a managing director of 10 years who left, and we had a de-gearing of the business. So Aveo Group, up until we participated, had raised $900 million of equity to de-gear a very debt-heavy balance sheet. The other key change for us in Aveo, and I'll describe the business in a moment, is the fact that it was a diversified property business. So they were trying to be all things to all people. They were a developer, they were an owner, they had retirement assets, they had commercial, industrial and residential developments. What we like now is that it is a very focused retirement village owner and operator, the second largest in Australia, and that is what their focus is wholly. So we think that, one, they will do a better job at it. It's not a poor cousin of the business, it was starved of capital, but also with the retirement villages in the portfolio being older than many in the market, it means that they're more mature, which means we get the turnover of residents, which generates better cash flow. A couple of the other attributes of Aveo Group we like is the fact that it has extensive brownfield development opportunities in the portfolio. So on about just under 10,000 units that they own and manage, there's circa 4,000 to 5,000 units that they can develop over the next 10 to 15 years without actually acquiring new land. And we think that's very accretive for shareholders because those developments come at a lower risk.
Yeah, okay. And to give the investor an idea, that's a stock that you followed since its previous life as Forrester Kurtz, FKP, and now as Aveo. And again, you'll keep in touch with the management. The annual reporting season in August coming up, that's one that you'll be watching and being at the briefings, etc.
Yeah, so we've done quite a few trips to see a number of their assets. I won't claim to have seen them all. There's plenty. But you're right in terms of following their history. So to put that in context, the current share price is around $2.70. Pre the GFC, the share price was on an adjusted basis close to $25. Wow, yeah. And the management had knocked back a bid from Lendlease at that price. So,
that's right. Yeah.
So a lot of damage has been done historically, which we think actually has provided the opportunity today.
Yeah, so you followed it. It's a lot of hard work in that. And Steve, you've done a wonderful job. It's been great having you here today to explain the fund and the performance and the way you go about things. That's all we've got time for. Thanks again, Steve. Thank you.
Thank you.